Get ready for a new episode of KP Talks Dollars and Cents. Learn financial literacy and get real-time updates on all things housing, finance, and real estate with your host, Kevin Perenio. As an owner and C-level executive for 20 plus years in finance, KP is here to serve you with all of his knowledge and experience. Whether you're a broker, realtor, or just interested in the economy, this is the podcast for you. So let's get started. Here's your host, Kevin Perenio.
Hey, it's KP coming to you live from the 55. Sorry, I'm driving, and I hope you can bear with me on this video. But I'll show you my car, which can be a Friday funny. I'll give you a tease. It's a Tesla. Don't hold it against me, all my Texan friends. I didn't get soft when I got here to California. But I've had this car almost 4 years, and it's pretty fun to drive. And I'll tie in why it's important. Because technology is deflationary. So wait for the end while I'm driving here. Here you go. You can see I'm on autopilot. My hand's free. Other hand's holding the phone. Anyway, velocity of money has been slowing down. And the velocity of money is a concept that keeps the economy going. And that velocity of money is needed, for GDP, for growth. And with liquidity being drawn out of the system because the Fed has been doing quantitative tightening, there's less money supply in the system. There's a shrinking supply or shrinking rate of growth of money supply. And with some of these potentially systemic risks, although all the three major bank failures plus one that got backstopped were all shored up and isolated by the help of Fed regulators and Treasury and Fed and all that kind of stuff. Which, by the way, shout out to Tim Mayopoulos, former CEO of Fannie Mae and president of Blend, is in charge of the new transition Silicon Valley Bank. I know you watch my stuff, Tim. You're a class act, absolute solid operator, and our entire banking system is well served. The fact that you're at the helm. I love how you asked SVP clients to put their money back in the bank and assuring that they're safe. What a great gentleman to be running that. So look, these issues got shored up, and that doesn't mean there isn't still risk. I heard a really good article that basically summed up the Silicon Valley Bank was that the executives that were running it prior to Tim underestimated the risk of an inverted yield curve, which is always, about duration. Shorter term bonds have higher yield than, longer term bonds by over a point last week, which is crazy. So it's basically, institutional money and smart money saying that we believe that trouble's on the horizon like a recession. Now, half of that yield curve inversion has gone away just in the last week because of all the money flight to safety into the 10-year treasuries. So we're watching that, watching the velocity of money, watching how that impacts our economy. Will the Fed do 50? Will they do 0? I'm firmly in the camp, and even before last week and all through the past week, I think they're going to be a steady hand and continue to fight inflation, which is the biggest risk to our economy. And they're just going to stick to their 25 basis point rate hikes. So next Tuesday and Wednesday is the Federal Open Market Committee meeting. And I think on Wednesday, they'll do 25 basis point rate hikes. The statement, will it continue to talk about disinflationary trend? Will they address the bank failures that have been happening in the system? The statement and the Q&A will be closely watched. So there's either 3 more 25 basis point hikes coming between now and June, or 2, or maybe it's the last one. And once the Fed stops, then, all the smart money will know, okay, well, this is how much funds are going to cost. This is how much, banks know that the Fed funds rate is. This is where we can, if we have to mark to market our treasuries like these bank failures had to do when they had to raise money, they'll know, what their capital risk is, and maybe, go use that new Fed fund to, shore up their defenses, which, by the way, about $300 billion of funds have been tapped by banks from that Fed fund that was created just since the weekend. So these banks are shoring it up. First Republic Bank out of San Francisco, great bank. I've got 2 loans with them on my 2 Picasso units. And Picasso, I'm assuming, has their money with them. JP Morgan Chase came to the rescue, and some other banks came in to help that bank and make sure there wasn't a run on that bank. Now, what's interesting is when deposits leave, like they did for Silicon Valley Bank or Signature Bank, there's no good assets there to offset the liabilities, the loans. And so these losses and getting that balance sheet, assets versus liabilities, getting more towards the liability side, you've got no equity. So these companies are basically insolvent. So they got to go raise money. So, again, not to recap too much, but, Silicon Valley Bank had to sell some of their assets, which are treasuries. They had a ton of mortgage-backed securities as well. And then when they had to sell them, instead of holding them for maturity and getting that yield all the way till the end, they were forced to sell, and they had to sell at losses. And that's when people started getting crazy and pulling their money out. Now, I read a great article from Whitney Tilson that said that there are 5% short float on Silicon Valley Bank. One guy has been shorting Silicon Valley Bank for a year because his analysis said that the money that's in there, all the money that's there for venture capital, large accounts, he deemed it fast money. And that's fast money that goes in and out. And right now there's a real liquidity drawdown for tech ventures and VC ventures. And so, that's fast money that could be pulled in and out of, of those accounts. And it did. And that ultimately is what created their balance sheet. So there were some smart money. There's a guy that's even pounding the table about, shorting Signature Bank 2 months ago. So this stuff's not over, but I think some lessons we learned on the amount of risk banks take, right? Or else their deposits go away. Now, I'm not going to sit here and beat my chest and make this about banks versus non-banks, but isn't it interesting that all this regulation and talk about shoring up capital, by regulators for non-banks has been heightened. But it's the banks that are failing. And these guys have regulators up their ass all the time. Maybe regional banks don't have as much regulation as maybe a national bank, like a big money center bank, like a Chase. But nevertheless, these banks are failing. Non-banks are not failing. And the reason why is because non-banks are pass-throughs. We're a non-bank. PRMG is a non-bank. Rocket, UWM, Home Point, they're not federally chartered, federally regulated, institutions. We're all, wow. Sorry. My autopilot doesn't really work in traffic and lights, so I had to put my eye on the road for just a second, but I'm still getting this video in. Anyway, so non-banks version of deposits are assets, if you will, are our people. And our people are our best quality for non-banks. Some of us do service. We do have MSR portfolio, and so there is some duration, there is some hedge instrument, but we can hold those for maturity, which, the average loan before COVID was lasting like 7 years. Who knows how long, our 3% notes will last. Maybe they'll last 10. Who knows? I don't know. But our people are our assets at non-banks. And obviously, we all perform as a team. And if our culture's sticky and you reach out to your, quote, assets, to your people, they stay with you, and especially when you have their back through tough times like we're having in our industry. So I don't know if Silicon Valley Bank was not doing enough outreach to their assets, to their clients, treating them like partners. I mean, shit, if I had $80 billion that could walk out the door in 24 hours, you bet your ass I'd know every single one of those people, and I'd be talking to them all the time, saying, hey, you're good here, you're protected here, here's what we're doing, we got your back. That's what we do with our loan officers, with our employees, with everyone every day. So that's how you treat your assets at a non-bank. I'm not sure why banks don't do the same thing, seeing how much risk they have if the assets walk away. Anyway, what's a good bet right now? Frickin' real estate. Now, I know gold is good too, but hard assets are looking really good right now when there's, recession risk, right? So once the inflation fight is over and we go into a recession risk, that is where, all the talk is going to be about the Fed. They're going to be talking about, ¿Qué pasa, amigo? Good man. Bien. So anyway, what I was going to say about the recession risk is that that is the next thing that we'll be talking about once the Fed stops their hiking.
But hard assets, real estate, roof over your head, great performing asset right now. We should do more of it, right? And there's not enough home supply out there. I'm going to talk about it next week a little bit more. But the $200,000 starting home price is pretty much gone. And so, there's not a lot of supply. We're woefully undersupplied yet again rolling into this year. Have a great weekend. Cheers.
Hey, it's KP coming to you live from Corona, California. And I'm finally at my desk with an update after all these bank closures and even yesterday in the original home of banking in Switzerland. It's supposed to be neutral, right? They had Credit Suisse taken into a forced merger with UBS, another bank failure. I read that it was about a $3.2 billion transaction for the assets, which were 10 times that, maybe more. So let's see. We had U.S. federal regulators coming in and backstopping First Republic Bank. We had Silvergate go out and the assets fire sold there, and of course depositors backed up after the fact. We had, of course, Silicon Valley Bank, which was the second biggest bank failure in American history, that went down, and those assets were taken and sold. And after the fact, the depositors were assured that their deposits, even if over $250,000, which is the FDIC, limit of prior to these bank failures, the FDIC fund that you and I pay for, by the way. There's a little fee that comes out of all of our money for all of our bank accounts in every single bank, pretty much. That's a depository that goes into this insurance fund. I think it's something like 164 billion, maybe it's 180 billion. I don't know what it is. Certainly not enough to handle hundreds and hundreds of billions, but we all are paying in part for some of this backstopping. And then we saw that Signature Bank out of New York went out, and New York Community Bank has agreed that part of the failed Signature Bank will be taken into one of its own subsidiaries of New York Community Bank. We all know Flagstar, great storied history here in our business with a bunch of good people. Hammond family, pretty cool. Mark and Kirsten, if you're out there watching. 40 branches of Signature Bank are going to be renamed Flagstar, which is good because the alternative that I saw in the meme world out there was at the Halloween store. They were just going to put up their banner over there where you can start to get your stuff. That's where all these empty offices were going to go. But in all seriousness, that $60 billion of Signature Bank's loans will be pulled into receivership by the FDIC and sold off over time. This was according to the Associated Press. And $2.7 billion is how much New York Community Bank paid for $38.4 billion in assets of Signature Bank, and then going to roll it up under a subsidiary, Flagstar, less than 10 cents on the dollar. Now, I'm a little under the weather, and so I tested out something I've never done before, and I wanted to see if I had to pause in the middle of my video for coughing to give you guys a break. But then it gave me an idea because I don't have an editor. But guess who's going to bail out non-banks? Any guesses? Waiting for the answers. Okay, I'm having too much fun. The answer is nobody's going to bail out a non-bank. Now, maybe a mortgage-backed security portfolio, which is really all Wall Street thinks we're worth, maybe that would be taken over, 10 cents on the dollar. I don't know. Would we be lucky to get par rate on a held for maturity asset like the banks are getting at record paces? Did you know how much money is being doled out by the Fed for all their funds at the Fed window, cash window lately? It's like $190 billion. The balance sheet of the Fed just went up like the highest and fastest percentages done in quite some time. No one is bailing out non-banks. And the secondary market, even though some of them are bailing out some of these banks, the secondary market is cold, heartless, and unforgiving. And don't you forget that. And we are seeing this on full display. It does not matter how long your company has been in business. We saw that with Lehman Brothers back in '08. And we saw that nobody that was a non-bank got bailed out and got to keep their name. Even Countrywide, one of the greatest, if not the greatest non-bank of all time, which I think they did actually at one point buy into a bank. But when there was a credit collapse, their assets were taken over by Bank of America. That time I paused to actually cough. Okay, so no one's bailing out non-banks, yet here we are, lending in the community, doing like 74% of all low to moderate income housing borrowing, independent mortgage bankers to be specifically. 94% of FHA loans are done by independent mortgage bankers. You may wonder why I know these stats, because here is 12:30 at night, and I am going tomorrow to the California Mortgage Bankers Association's Legislative Day in Sacramento. I have a 7 a.m. flight. That's right, I'm not sleeping. It's been a long day. We're 18 and a half hours in today. So the talking points are something we're going to bring up to the California legislators and banking committees and let them know how we feel that originators teach financial literacy at scale. And a lot of that happens from independent mortgage bankers. And of course, if we have a wholesale channel, those originators that we serve and the TPO channels. So those stats about it's 97% of FHA loans, 91% of VA loans, and 93% of rural housing loans are from independent mortgage bankers. So in California, more than 74% of home purchase mortgages to minority borrowers are done through independent mortgage bankers. So yeah, no reason to bail us out. We're the ones doing all the hard work here. But let's hold us to a higher standard, and then we'll spend billions of dollars of our money and pay for, anyway, I digress. Anyway, looking forward to being part of the California MBA Board of Directors this year and lobbying on behalf of not just Californians, but everybody, because we're going to talk about remote online notarization. A lot of times what happens in policy in California or New York or Massachusetts or Illinois does tend to spread to the rest of the country. So I'll be lobbying on your behalf tomorrow. You're welcome, and thank you. Okay, so what else is going on? All right, so First Republic Bank, which I mentioned on my video last week, I have 2 loans through. They have $212 billion in assets at year end. $2 billion of it is mortgage-backed securities, okay? So Silicon Valley Bank had a lot of mortgage-backed securities, and there's a lot of talk about how that having to be sold because it was their most liquid asset, which the MBS market is pretty liquid, but having to sell at market rates, marking to market versus holding to maturity. You know, some people say that these mortgage-backed securities are going to last forever, right? The average loans were lasting 8 years. There are people that are buying mortgage-backed securities with strong balance sheets that feel that those borrowers are going to be making payments for quite some time. And if that's the case, then, you know, that's a great asset, right? So these assets, only $2 billion on First Republic's bank of mortgage-backed securities, is held to maturity. And they had another $2.6 billion available in its for sale account. So money was raised, something like $35 billion. I think Chase was the leading, JP Morgan Chase was the leading bank, getting that stuff out the door. And just to give you that stat, that exact number on how much money, banks have borrowed $165 billion from the Fed over the past week, and $11.9 billion has come from the Bank Term Funding Program, which is a new program that's out. Thank you, Les Parker, for that information. And what else is out there? I will tell you that when the Fed slams on the brakes, somebody goes through the windshield. You just never know who that's going to be. Humongous Fed meeting the next 2 days. Obviously, the statement and the Q&A at the end is the most important part, and that comes on Wednesday. My guess is, like I said last week, regardless of we were at 25, then it's going to 50 because inflation's hot lately. Oh, now the banking crisis, we're back down to 0. I think it'll be steady Eddie from the Fed. They're going to say 25 basis points like it was projected. Even the CME tool is saying that. But what is interesting will be what they will say about this banking contagion. And my guess, which will be deemed probably hawkish, is they'll say, hey, you know what? There is no systemic risk. Clearly the system worked. Federal regulators came in and Treasury, and we came to the rescue and we backstopped these banks. For banks that were caught off sides for idiosyncratic and very unique investment strategies that we don't agree with. So we shall see. I don't see them pausing. I don't see them going 50 and no 0. Cheers. Hey, it's KP coming to you live from Corona, California. The Fed hath spoken, and the word is out, 25 basis points, steady hand. He was undeterred by a potential banking crisis and inflation and all that kind of stuff. However, he did sound a little bit sheepish, a little dovish. I read one commentary, I believe it was Les Parker, said that Jay Powell was aggressively waving a white flag. So what happened at the Fed meeting? What's going on? And what are some nuggets that we can pull out of there? And I'll pull from a bunch of different resources. Now, when I watched it, I was in Sacramento and on my way to the airport watching the press conference. And by the way, it was really awesome to go meet with state senators and state assemblymen in California, together with our board of directors at the California Mortgage Banker Association, lobbying on behalf of all of us in California. And we think, we think some of the policies set here can really spread their way across the country. So it was a good experience for me personally, my first time to go sit there and lobby and see the meat grinder and see how it all worked up there in Sacramento. Hotel we're staying at, the Kimpton. Me and John Hedlund over there from AmeriHome, now part of Western Alliance Bank. All the Celtics were roaming around, so it was kind of cool. We roamed in and seeing all these different people there, and the buses, the fans. They played the Kings that night. I didn't see the game, but it was wild. Anyway, trying to get remote online notarization pushed in California, among some other things. Don't give us a CRA act, all that kind of stuff. I could go into all that. Anyway, awesome board meeting. That group is very strong, doing great with cash position and savings and, trying to get some fundraising done. California Mortgage Innovator Conference is coming up soon. Then that's in Anaheim, and then the Western Secondary, which is in Dana Point, the Waldorf Astoria. Totally cool. Thank you, Susan Milazzo, for kicking so much butt that organization for so many years. All right. So I was listening to the Fed, and the one thing that I wrote down was that he was talking about the different components of inflation. And he said that 56% of the CPI comes from non-housing services, and that is still stubbornly high, or maybe even said was increasing because of some of the last reads. And that was the one thing I picked out. Now, I didn't really dig into what, every component was, but, hat tip over to Barry and Dan Habib at MBS Highway, a couple hours ago, and it's late, again, on a Thursday night, really Friday morning after midnight. I won't even tell you what time it is. You can tell by when I post the video. But Dan and Barry, they did a good job of breaking down kind of some of the components that were part of that non-housing services. But we all know that services, in general, is still the sticky part, right? Everyone paid a lot for goods during COVID, and it pulled forward a lot of demand for goods, and that killed the supply chain, and now that's kind of come down, and now people are spending money on leisure, hospitality, travel. They're going to restaurants. So whatever the percentage is, whatever the component is, at least what Jerome Powell is saying is that is still a sticky part of inflation, and that's true. However, if you look at the PCE, or the CPE, I guess consumer price expenditure, that's really the big one. CPI, what the consumers are paying, producer price inputs, consumption expenditure, all these different measures of inflation. They're still high, but if you look at what's happened with the 2-year Treasury and the 10-year Treasury, those have come down. The 2-year Treasury's come down 140 basis points in like a week. I mean, that's, remember we talking about the 10-2s, the inverted yield curve, the sign of of a recession coming? Those are market rates, right? And so the Fed's rate is now, their terminal rate is now 4.75 to 5. They're basically at 5%. And the market rates are coming down. So the 2 and the 10s are coming down. The 10-year closed today at 340. Can it run to 280? Can it below 330 at least. There's, or is going to run back up to 380 and just kind of trade in this range. Not really sure. We've got some inflation readings coming out next month for March. And of course, the first Friday of April will be the March jobs report. So obviously super important. And we'll watch all the data along the way. So, so many different takes on the information that's there. But the bondinistas, the bond traders, the smartest people on Wall Street, they're already pricing in cuts. They're already pricing in, recession. They agree the fight for inflation is generally over, even though the Fed hiked rates again for 25 basis points. Interest rates for mortgages, by the way, didn't go up. There's a decoupling. They're not necessarily related one-to-one. The 10-year Treasury has more of a correlation to mortgage interest rates, and that has been coming down. And therefore, mortgage interest rates have been coming down, and applications have been going up. Maybe spring purchase season won't be a bust. Man, we're so interest rate driven. Such a boring, predictable business, right? Interest rates go up, business goes down. Interest rates go down, business goes up. So we're noticing that as we head into April, April, May, June, these are big heart months of the spring purchase season. And many areas are starting to thaw out. Spring is almost sprung in certain areas. I know it's still cold, but we're almost at that 6-week mark from Punxsutawney Phil telling us that winter was going to be extended. And so when spring turns around, it is a new beginning, a new season, a new pivot. So did the Fed just pivot? Or at least, a part of a pivot, right? They've had smaller increments, and then they're going to freeze, and then at some point they'll cut. Remember, Fed pivot used to just mean only when they cut. When are they going to do that? I don't know. End of the year? Next year? This banking scare was a big deal. It was the first thing Jerome Powell talked about. This banking collapse potential, contagion and everything that went on. It was the first thing he talked about at his press conference. So it's on his mind. And it's interesting to hear a lot of talking heads say that because of the regional banking crises, that credit standards and credit will tighten. That banks who lend money, especially regional banks, will start to tighten. I heard one, I think it was Brent Talkington on CNBC, she said pencils will be down on giving out new credit and new lending. And that has an effect on tightening credit, on shrinking liquidity, on causing us to potentially go into a recession. Some of the talking heads are saying that the amount of tightening that will be occurring with higher interest rates now that we're at a 5% terminal rate, and of course with the banking crises and the potential duration issue, that shout out to Chris Whalen over at Institutional Risk Analyst. He's been talking about it for a long time, talking about duration and how it's a problem. He's been pounding the table on it, even calling JP Morgan insolvent if they were to mark-to-market all their assets. But that duration problem is going to bring that down. And that credit tightening, the talking heads are saying, equates to maybe 2 or 3 more 25 basis point rate hikes. I'm not saying there's going to be 2 or 3 more. There may not be any more. But the tightening by the banks is the equivalent of that. So we have bank tightening, the Fed's running off their balance sheet for treasuries and mortgage-backed securities, while at the same time recently expanding their balance sheet by offering the special program for a year to buy these duration assets like mortgage-backed securities and treasuries at par value for a year, backstopping the FDIC's insurance fund, because of course they can't insure anything that would continue to spread. So 4,200 banks in America, and 10 have 50% of the assets. We are too big to fail. Our debt's too big to fail. And the banks that did fail, Signature Bank and Silicon Valley Bank, which Silicon was a big one, obviously second biggest bank failure in our history. Those 2 bank failures alone accounted for the equivalent of 1.5% of our GDP in assets. Now, in 74, 84, and 88 recessions, we had about 1 to 2% equivalent of GDP assets fail in banks. And that was it. And then the stock market rallied. And I am not a stock advisor. I'm not responsible for your profits. Yeah, I'm responsible for your profits, but not your losses. Almost messed it up. In the 08 recession, we had 7% of GDP bank failures. We're nowhere near that. We're not like that. Therefore, This bear market could be over. We could be rallying. I don't know. Maybe it's time to pivot. The Fed seems to be done. We're going to see the dot plot. And my boy Louis Navalier, he says it's over. Fed says ongoing is no longer part of their language. We are firming. I don't know. Might be done raising. Have a great weekend. Cheers.
You've been listening to KP Talks Dollars and Cents, a top-rated show for those who want to learn about the economy and mortgage environment. Tune in each week for more episodes, and please leave us a 5-star review on Apple Podcasts and Spotify. Kevin Perenio does not render or offer to render personalized investment or tax advice through KP Talks Dollars and Cents. The information provided is for informational purposes only and does not constitute financial, tax, investment, or legal advice. For more info, follow KP Talks Dollars and Cents on all of our social channels.